In this video, we'll learn how to catch reversals on the M15 time frame at the top of the day or bottom of the day as illustrated. So we are basically saying after the market moves in an upward or a downward market direction, we will be able to catch their reversals for intraday trades. So this will only be done on the M15 time frame as we'll explain in this video. So make sure you stick up to the end to fully comprehend and apply the whole process on your charts. So every trader knows about the M's and W's or basically double tops or bottoms. So if you ask any seasoned trader, they will tell you that the first and foremost, actually the initial strategies that they used involved these double tops or double bottoms. However, do you know where to catch these on the M15 time frame or where to expect them? If you do not know, this video is right for you. So knowing the following sequence will simplify the whole concept of spotting these reversals. So it only takes 4 steps to find an entry. You only need these steps to get a proper entry using this particular concept. We call it crossover, bounce, bounce, and pattern. It's basically something that you can get and know by heart. It's crossover, bounce, bounce, pattern. If you can repeat after me, crossover, bounce, bounce, pattern, it means you can trade this particular concept. If you follow us for quite a long time, you know that we have an array of EMAs we use. For this concept, we need the 13, 50, and the TDI, those 3 indicators, and these are applied as follows. Before we define the pattern, please hit the subscribe button and check the notification bell icon so that you won't miss any of our future videos. We have a free signals Telegram channel which we plan to send a lot of free signals this 2023. Find the link in the description box below. So here's the illustration of what we were talking about. The 4 steps that we have referred to is the crossover, bounce, bounce pattern. We are saying the first thing that you need to see is basically the 1350 EMA crossover as the first step, right? After seeing the 1350 EMA crossover, you'd know that we are now in a particular bias, right? The next thing is to see price bouncing on the 50 EMA first and bouncing on the second EMA second. After the second bounce on the 50 EMA, you would know that we are now in preparation of a particular pattern, either a W or an M, depending on the market context. In this case, the 4th step is now to see the pattern and take the market as a reversal, right? So let's now go over the charts and see how all this is done. So, if you recall very well, we have said we need a crossover first, a bounce, and a pattern, right? So wherever we see a crossover, we had crossover, but the last crossover was at this point. 13 is the one in red, 50 is the one in blue, right? So those are the only indicators that we are going to be using for this particular strategy. And the bottom part is the TDI, basically used for the pattern confirmation. In this case, we had a crossover of 13 and 50. Then from that, we had a drop and a bounce on the 50, although it actually protruded, a drop, a bounce on the 50, and we've said after the second bounce, that is when we start to look for a pattern. So the first bounce, we are saying it was here. Then the second bounce, the first bounce, then the second bounce. Then after the second bounce, we start to look for a pattern. A W pattern was issued. Then to confirm that, we need to have a rise of the relative strength index. The green line is the RSI line, which shows us that the relative strength index is either dropping or rising. In this case, it was actually rising, confirming that this particular pattern was actually correct. We can as well define this as divergence of the market price. Then from there, we had a crossover, but did we have two bounces along the way? No. Then we continue. We can see that at this point, we had a crossover that occurred at this point, right? The first bounce was this one. We had the first bounce. Then from there, we had the second bounce, which was this. So we had crossover, bounce, bounce, and then pattern. Where was our pattern? We can see the first leg, right? Then we could call this the second leg, but it was properly to be traded at this second leg, which was proper, right? We start again our count. We can see that we had a crossover. After that crossover, we had the first bounce on the 50 EMA, which is this one. Then we were waiting for the second bounce. Along this rise, there was no bounce, and a bounce was later issued at this point. So you should be highly disciplined to wait until the sequence of crossover bounce bounce pattern has been issued. From there, we can see that there was now it was, although an ugly pattern, but it was first leg, second leg with several retests of the second leg, but unfortunately the market went our way like that. Then after that, we can start again. We can see a crossover at this point, right? After that crossover, we can see the first bounce. It was several touches, but although it was the first bounce, then the second bounce was issued. After the second bounce, we started to look for a pattern which had first leg and then the second leg, and the market went our way. So in this particular case, we are only looking to get 30 to 50 pips per trade so that we actually get out of the market in an intraday form or intraday style. On that note, we come to the end of our video. Thank you for watching. Like and subscribe. See you on the next one.